Have you ever wondered what equal weighted index ETFs are and how they can benefit your investment strategy? Well, let's start by breaking down the term. An equal weighted index ETF is a type of exchange-traded fund, which is essentially a basket of different types of investments like stocks, commodities, or bonds. Now, what makes an equal weighted index ETF unique is the way it's structured. You see, in this type of fund, each component of the index carries the same weight. This means that every company in the index, no matter if it's a multinational conglomerate or a small-scale startup, contributes equally to the index's performance. So, you might be asking yourself, what does that mean for me? Well, it means that your investment isn't overly dependent on the performance of any single company. It's a way to diversify your portfolio and potentially mitigate some of the risks. In simple terms, no single company dominates an equal-weighted index ETF. Now that we know what equal-weighted index ETFs are, let's delve into how they work. Equal-weighted index ETFs function in a unique way, diverging from the more common market cap-weighted indexes. In a market cap-weighted index, the weight of each component, or company, is determined by its market capitalization. The larger the company, the more it influences the index. In contrast, an equal-weighted index ETF gives each company an equal chance to impact the fund's performance, regardless of its size. Here's how it works. Let's say you have an equal-weighted index ETF that tracks 20 companies. In this case, each company would be given a 5% weight, adding up to 100%. This means that a small company has the same influence on the index as a large company. A key part of maintaining an equal-weighted index ETF is the process of rebalancing. This typically happens on a quarterly or semi-annual basis. The fund's manager will buy and sell assets to ensure that each component maintains the same weight. So, if one company's stock price rises significantly, the fund manager will sell some of its shares to bring its weight back to 5%. Conversely, if a company's stock price drops, the fund manager will buy more of its shares. Rebalancing can lead to higher transaction costs, as it involves frequent buying and selling of assets. These costs can eat into the fund's returns, especially in a volatile market. However, rebalancing can also provide opportunities for better performance. For instance, if a company's stock price drops, the fund manager will buy more of its shares at a lower price. If the company's fortunes turn around, these additional shares will contribute to the fund's performance. Similarly, by selling shares of a company whose stock price has risen significantly, the fund manager can lock in gains before a potential downturn. So, in essence, equal-weighted index ETFs work by giving each company an equal chance to impact the fund's performance. They offer a unique way to diversify your investment portfolio while also providing potential opportunities for better performance. So, an equal-weighted index ETF gives each company an equal chance to impact the fund's performance. With the basics out of the way, we can explore some examples of popular equal-weighted index ETFs. Let's start with the Invesco S&P 500 equal-weight ETF, often referred to by its ticker symbol RSP. This ETF offers a unique perspective on the S&P 500, giving equal weight to each company in the index, rather than prioritizing those with the highest market capitalization. In other words, it doesn't let the big players dominate the performance. Next, we have the First Trust NASDAQ 100 Equal-Weighted Index Fund, known as QQEW. This fund does something similar to RSP, but within the realm of the NASDAQ 100. Each of the 100 companies in this index, regardless of size, gets an equal slice of the pie. Both of these ETFs offer a way to diversify your portfolio across a wide range of companies without giving undue influence to the market's giants. These are just a couple of examples, and there are many more equal-weighted index ETFs out there. Why should you consider equal-weighted index ETFs for your investment strategy? Well, there are several compelling reasons that may pique your interest. Firstly, equal-weighted index ETFs offer a significant level of diversification. Unlike their market cap-weighted counterparts, they don't overly rely on just a few large companies. This means that the performance of your investment isn't tied to the fortunes of a small group of mega-cap companies. Instead, it's spread across many different companies, providing a more balanced exposure to a particular market or sector. Secondly, equal-weighted index ETFs can offer better performance potential. Smaller companies, which tend to be overlooked in market cap-weighted indexes, get a fair shake in an equal-weighted index. With more room to grow, these smaller companies can sometimes outpace their larger peers in terms of growth, leading to potentially higher returns for you. But it's not just about the potential for higher returns. Equal weighted index ETFs can also help to reduce risk in your portfolio. By spreading your investment across a broader range of companies, you're not putting all your eggs in one or two baskets. If one company or sector takes a hit, it won't wipe out your entire investment. To sum it up, equal weighted index ETFs can be a great way to diversify your portfolio and potentially boost returns. So why not give them a look in your investment strategy? After all, it's all about finding the right balance to achieve your financial goals. However, like any investment, equal weighted index ETFs come with their own set of risks. Let's take a moment to delve into some of these potential drawbacks. One notable downside is the higher transaction costs that can be associated with equal weighted index ETFs. This is primarily due to the requirement for regular rebalancing. Unlike market cap weighted indexes, where the weightings naturally evolve with the market, equal weighted indexes need to be adjusted periodically to maintain their equal weighting. This frequent rebalancing can lead to increased transaction costs which, over time, can eat into your returns. A second disadvantage is the potential for increased volatility. Equal weighted index ETFs often have a greater exposure to smaller companies compared to their market cap weighted counterparts. These smaller firms, while offering the potential for significant growth, can also be more sensitive to market fluctuations. This sensitivity can lead to greater volatility, which may not be suitable for all investors, particularly those with a lower risk tolerance. It's also worth noting that these ETFs can underperform in certain market conditions. For example, during a bull market where larger companies tend to outperform, an equal weighted index ETF may lag behind a market cap weighted index. While equal weighted index ETFs offer potential benefits, it's crucial to understand the risks and consider them in the context of your overall investment strategy. And please like and subscribe if you liked this video.